Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 6th of November. I'm Daniel Lam, your host for the podcast. For us chess players, our ratings are indications of our strength. Now, we get our new rating at the start of each month, or you can look at that as our monthly report card. Now, the rating adjustment comes from the number of points we scored in our competitive games in the preceding month versus the number of points that we were expected to get according to our rating. Now, in the world of finance, the reaction of the asset classes that a central bank is supposed to influence is a function of what it delivers versus how it has been managing market expectations. Now, in that sense, the latest from the Bank of Japan may have been viewed as a disappointment. In the monetary policy meeting last week, the BOJ tweaked its yield curve control, YCC, by redefining 1% on the 10-year JGB yield as an upper bound reference rate instead of a rigid cap, giving more flexibility in its YCC policy. However, the markets were expecting even more hawkish development by the BOJ because Japan's inflation has been above the bank's 2% target for 18 months, and business investment has been strong. It seems that after years of deflationary trend, the BOJ decided to play it safe and prefer to adjust the YCC policy incrementally. Indeed, the BOJ lifted growth and core inflation forecast for financial year 2023, but it downgraded its financial year 2024 growth forecast to 1% versus July's estimate at 1.2%, and raised the core inflation forecast marginally to 1.9%, but still shy of 2%. But we continue to believe that the BOJ is likely to tighten policies over the next 12 months with a de facto removal of the YCC, followed by normalization of the negative interest rate policy, NIRP, when the inflation path becomes more apparent. Rising inflation and depreciating currency is a challenge for the BOJ, and the risk here is that the bank may face pressure to abandon the NIP policy sooner rather than later. In terms of technicals, the dollar yen is now above 150, and intervention from the BOJ remains a real possibility. The key support levels for this pair is at 147.15, followed by 144.20. Now that second level is close to our 3-month forecast at 145, and 135 is our 12-month forecast. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.